Hey everyone, welcome back to the channel. Today, we're diving into one of the safest investment options available in Canada, the Guaranteed Investment Certificate, or GIC for short. If you're looking for a secure way to grow your money, especially in these uncertain times, this video is for you. Let's break it down. So what exactly is a GIC? A Guaranteed Investment Certificate is a financial product offered by Canadian banks and credit unions. When you invest in a GIC, you're essentially lending your money to the bank for a set period of time, and in return, they guarantee that you'll get your money back plus a little extra interest. Here's how it works. You choose how much you want to invest, and then you select a term. This could range from 30 days to 5 years or even longer. During this term, your money is locked in, and in return, the bank pays you a fixed interest rate. Once the term ends, or what's called the maturity date, you get your original investment back, plus the interest. There are a few different types of GICs to consider depending on what you're looking for. Along with each type, you'll see some GICs and their rates that are offered today toward the end of 2024, just to be able to compare and get a sense of them. Cashable or redeemable GICs. These allow you to withdraw your money before the maturity date, but the interest rate is often lower. Non-redeemable GICs. With these, your money is locked in for the full term, but you usually get a higher interest rate in return. So when is a cashable or redeemable GIC a good option if it pays a lower interest rate? Cashable GICs allow you to access your money before the term ends without heavy penalties, unlike non-redeemable GICs where your money is locked in for the full term. While cashable GICs usually offer a lower interest rate, they're ideal in a few key situations. Emergency fund. If you're building an emergency fund and want your money to grow safely, but still need the flexibility to access it in case of an unexpected expense, a cashable GIC could be a smart choice. Short-term goals. For short-term savings goals like a down payment on a home or a vacation fund, where you might need access to your money within a year or two, a cashable GIC gives you the flexibility to withdraw early if your plans change. Uncertain financial needs. If you're unsure when you'll need the money or want the security of having it available without committing to a fixed term, a cashable GIC offers the option to withdraw before maturity, making it great for those who value flexibility. Fixed-rate GICs. These offer a guaranteed interest rate for the entire term. Variable-rate GICs. Here, your interest rate might fluctuate based on market conditions. Let's talk a bit more about the variable rate, as it seems more complicated. One of the unique features of a variable rate GIC is that your interest can fluctuate over time. But to manage this variability, many variable rate GICs come with a minimum and maximum interest rate. Let's break down how this works. The minimum interest rate is the lowest rate you will earn no matter how low the market rates go. Even if the prime rate or other factors that influence GIC rates drop significantly, you'll still earn this minimum rate. This provides a safety net, so you won't be left with zero growth on your investment. For example, if your GIC has a minimum rate of 1%, that's the least amount of interest you'll earn during the term, even if the market performs poorly. On the other hand, the maximum interest rate is the highest rate you can earn, even if market rates soar. This cap is put in place by the financial institution to limit how much they pay out in interest. So if your GIC has a maximum rate of 5% and the market rates go beyond that, your earnings will be capped at 5%, regardless of further increases in rates. While the returns aren't as predictable, they can offer higher potential earnings under certain circumstances. So, when is a variable rate GIC a good choice? If you believe that interest rates are likely to increase during the term of your GIC, a variable rate GIC could be beneficial. As the rates rise, so does the interest you earn on your investment. This way, you're not locked into a lower rate. If you don't mind a little bit of risk, while your principal is still guaranteed, the interest you earn can fluctuate. If you're comfortable with the possibility of earning less if interest rates fall, this type of GIC could work for you. Now, you're probably wondering, how much can you actually earn with a GIC? The return you get depends on the interest rate and the term you choose. Let's go over some examples. Imagine you invest $10,000 in a GIC with a 1-year term and an interest rate of 4%. Over the course of 1 year, you'll earn interest based on the principal amount of your investment. In 2024, you invest $10,000. By the end of 2025, your investment will have grown by 4%, earning you $400 in interest. So after 1 year, your total investment will be worth $10,400. Now, let's say you invest $10,000 in a GIC with a shorter term, 30 days, and an interest rate of 2% annually. Since this is a short-term investment, the interest is calculated for the 30-day period, not the full year. In February 2024, you invest $10,000. By March 2025, your GIC earns interest at 2%, which amounts to $200 annually. However, since the term is only for 30 days, you'll receive a proportionate amount of interest. So after 30 days, your total investment will be worth $10,067. Now, let's talk about taxes. In Canada, interest earned on a GIC is considered taxable income. But the tax treatment varies depending on where you hold the GIC. If it's in a TFSA, the interest grows tax-free. If it's in an RRSP, the interest is tax-deferred until you withdraw it. However, if you hold the GIC in a non-registered account, the interest is taxable, and you'll need to report it on your tax return. So, why would you choose a GIC over other investments? Here are a few reasons. Safety. GICs are one of the safest investments because they're backed by the bank, and many are insured by the Canada Deposit Insurance Corporation, CDIC, up to $100,000. Note that this insurance is per bank. So, you can invest $100,000 in one bank and another $100,000 in another bank, and both of them are insured by the CDIC. Isn't that incredible? So make sure to invest your money in multiple banks if you want to invest large sums of money in GICs. Predictability. Since the interest rate is guaranteed, you know exactly how much you'll earn. Unlike stocks or mutual funds, GICs aren't affected by market fluctuations, so they're a good option for risk-averse investors. But GICs aren't perfect. Here are a few downsides to consider. Low returns. Compared to other investments like stocks or mutual funds, GICs offer lower returns. Locked-in money. Your money is tied up for the term, and withdrawing early can come with penalties unless you have a cashable GIC. Inflation risk. If inflation rises higher than your GIC interest rate, your money could lose purchasing power over time. Ready to start investing in GICs? It's easy. You can open one at your bank, credit union, or even through online financial institutions. All you need is a deposit, which can be as low as $500, and to decide on the term and interest rate that works best for you. So, if you're looking for a safe and predictable way to grow your savings, a GIC could be a great option. Thanks for watching, and if you found this video helpful, make sure to like, subscribe, and hit that notification bell for more personal finance tips. See you soon.